so today we're going to talk about bad debt expense. So there's two primary methods of bad debt expense estimation. The first method that we're going to talk about is the percentage of credit sales. And then the second method that we're going to talk about is going to be the aging of accounts receivable. Just really quickly, you may remember at the end of the chapter talking about the direct write-off method. We do not use that method because that method is not considered GAAP. The direct write-off method says, hey, we're going to be lazy. We're going to wait till the end of the period, see who does not pay, and then we're going to write it off. Unfortunately, we can't do that for GAAP purposes. GAAP tells us that because of conservatism, because we want to make sure that we truly estimate our expenses and our bad things and underestimate our good things, we need to go ahead and record some bad debt expense because we know we're going to have it. When we're talking about selling things on credit, somebody's not going to pay. I mean, that's just always the case. And so with that being the case, what we're going to do is a method of estimating who is not going to pay. So before we get into that, let me just write up the journal entry. So we're going to have a debit to bad debt expense, and then a credit to allowance for bad debt. Now, they may call this the allowance for, what's the other way? Doubtful accounts or something else. But basically, it's the same thing. So, bad debt expense is always going to be our debit, and then allowance for bad debt or allowance for doubtful accounts is going to be our credit. Remember, allowance for doubtful accounts is a contra asset. All right? It's a contra asset because what happens is it shows up on our balance sheet, because assets are on our balance sheet. It shows up on our balance sheet as a way to reduce our accounts receivable. So you're going to have your accounts receivable written out on the balance sheet. So you're going to have a section that's going to say accounts receivable, and then you're going to subtract the allowance. And then that's going to get us to our net accounts receivable. All right, so you may have seen that before, but if not, then that's kind of the full picture. So regardless of which method we choose, this will always be the journal entry for us to estimate the bad debt. Remember, this is to estimate the bad debt. This is not what the journal entry looks like when we actually write off the bad debt. All right, so remember, that's to estimate the bad debt. Once we actually have a situation where our customer decides they're not going to pay or whatever the case is, then we actually have to write off the bad debt. The journal entry to do that is going to be a debit to allowance for bad debt, and then a credit to accounts receivable. What's happening here is the customer is saying, hey, I'm not going to pay. So accounts receivable is our asset. We have to bring that down. We have to show that our customer is not going to pay. And then we're going to debit allowance for doubtful accounts, because basically allowance for doubtful account is kind of like a pot of money. It's like this bucket. When we're estimating the bad debt, we're putting money into this bucket. It's a credit account because it's a contra asset, but we're putting money into this bucket called allowance. As we use the money up, as our customers decide that they're not going to pay, then we go into the bucket and we pull money out. We use the debit to allowance for doubtful accounts in that scenario because we're taking money out of the bucket. All right? And so throughout the year, depending on which method we use, we're going to be putting money in and taking money out of the bucket. All right. So with that being said, just really quickly, let's go into the two different methods. So we have our percentage of net credit sales. And then on the other side, we have our aging of accounts receivable method. All right, so we have our aging of accounts receivable method. Two different methods to do the same thing. Under the percentage of net credit sales method, it's the easier method. All we do is they tell us our net sales was, let's say, $1 million for the month. They tell us that we're going to estimate bad debt at 1%. So then we just take this, multiply it by 0.01%. That's going to be 1%. And then our our amount is going to be, let's see if I can do this right. $10,000. That's going to be our estimate. If my math is wrong, then please forgive me because I do not do math in my head anymore, which is really sad. But anyway, I digress. All right, so this is going to be the amount that we put into our journal entry. We're done. That's it. The percentage of net credit sales is the easier method. However, now if we go over to the aging of accounts receivable method, what will usually happen is they'll give you a range. From 0 to 30 days, we'll have, let's say, $25,000. And then let's say, we'll keep this simple. 31 to 90 days, we'll have another $50,000 uncollectible. And they'll tell us, oh, well, 2% of these are going to be uncollectible. And then 5%. Let's say 5%. All right, and so I really should have brought in a calculator with me. All right, 1% would be 2,500, so 2% is going to be 5,000. And then, what is it, 5,000, 25, no. Goodness gracious, this is so sad. All right, 1% of 50,000 is going to be 5,000. So 5,000 is going to be. That's not right. That's going to be that would be 50%. Would be 500. So it'd be 2,500. All right, and this is going to be 500 and not 5,000. All right. So now that we wasted 2 minutes doing basic math, all right. So now we add this up. We get 3,000. 3,000. Normally, because if you're looking over here, you want to think, oh, I'm done. Let me put this into the journal entry. However, under the aging of accounts receivable method, that is not what happens. This is not the number that goes into your journal entry. All right, I'm going to erase this over here so I can really quickly kind of show what happens. So what happens here, under the aging of accounts receivable method, you kind of take it back to a T account. All right, so this is our allowance T account. More than likely, they're going to tell you you have a beginning balance, a beginning credit balance of, let's say, 2,000. This number becomes your ending balance. That is what you want. This is very important. This is the whole where everybody goes astray. This is the number that you want. This is where you want to end up. Okay? So the calculation that you get here tells you where you want to end up. This amount that you need to add to the beginning balance to get to where you want to end up. This is the journal entry. This is the amount that is going to go in the journal entry. All right? And that's pretty much it. If you can understand that concept, then you pretty much got the whole chapter down. I know I went really fast and I really wasted your time on some bad math, but hopefully overall you're able to understand what happened here. If you have any questions, please let me know. I do read all the comments and I really appreciate it. So just keep them coming. Thanks.